The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. This is Chris. It's Wednesday, September the 5th, and I hope all of you have had a wonderful summer. It's hard to believe that summer is officially, over. That you had a great 3-day weekend, and looking forward to a fun fall. That maybe the fall can get a little bit more movement and get us out of this trading range. So we're going to discuss some of those ideas today. But as a reminder of the power of the pattern, we want this to be your 30-second solution that you can look at the charts, see the opportunities at hand, see what patterns, what it's saying, and also where the risk management lines in the sand happen to be from a risk management perspective. We are going to have a quiz today, and we're going to have a couple of winners on a quiz. And just to remind you, if you can take the orange, the slide out box probably on the upper right of your screen and hit the orange arrow to bring it out to the top or bring it out to the left. And if you have an answer to the quiz today, just please type it in under the question piece, and Rick will monitor who gets the correct answer first, and we'll send you a $25 Amazon gift card for having a correct answer. So as a reminder, as we start off each week or each month's webinar, is that we're not a bull or a bear shop. We're bullish on opportunities, but we're not perma bulls towards stocks, bonds, gold, metals, or bears of stocks, bonds, golds, metals, bonds, commodities, you name it. We're going to take the opportunity, at hand and try to make something of it. So we're going to start off with which I continue to think is one of the most influential mathematical issues to the market, and that mathematical happens to be emotional as well. As you've seen, we started talking about the 261 level back in 2015. So this has been important to us now for over 36 months. And what is the 261 level? Well, we took the monthly closing high in the 2007 high and the monthly closing low of the financial crisis in 2009. And in my humble opinion, I believe those are the two most important emotional highs and lows in now the past decade. And when you apply Fibonacci to those, the highs and lows of 2007 and 9, the 261, in other words, a 261% advance out of that trading range, which is the darker blue section out here, comes into play on SPY at 285. So in January, when this was hit, I sent out an email to premium members and sector members both that I thought the following would happen: that the 261 level would be very heavy. It would be an 800-pound gorilla for months. I didn't think that it would cause a bear market to start, but I did think it would cause a lot of choppiness to take place. I did advise to have just think of capital preservation, that having a lot of money in cash would be important, because I thought the market would chop quite a bit. Opportunities, if when taken, you'd really want to take a small position, because the odds in a narrow trading range are against all of us, me, you, everyone in the world. They're very tough to trade. And so I wanted to empower you both financially and mentally of what was to come, what I thought to be in the future. It didn't mean it was going to happen, but I just felt it was that important to try to make those statements. And I tried to stick with those guns, and I still don't think anything else different than at that time frame. So the first quiz today, I want to reward people that are early on the webinar, is since hitting the 261 level in January, the S&P, which investment has made the most money in the past 8 months? Has it been the S&P 500, the New York Stock Exchange, EFA, emerging markets, China, or T-bills? And so again, the question is, since the market hit the 261 Fibonacci level, and when we said capital preservation would be the key to your investment strategy for a period of time to come, which investment has made the most amount of money in the past 8 months? Has it been the S&P, the NYSE, EFA, emerging markets, China, or Treasury bills? And you probably got enough time already to come up and figure that out. But just for In case you need to think about it a little bit more, we'll just give you a few more seconds. So Rick's probably got several people sending some inquiries by this time. But from a Joe Friday, just the facts, folks, this is the performance of many key indices since the S&P hit the 261 level in January. You can see in the upper right of the performance, the S&P is up 0.8%. The New York Stock Exchange is down 5. Germany, when we look at Europe, the DAX is down almost 10%. Emerging markets are down almost 20, and China is down 23%. So for the majority, there's been obviously some individual issues. The best thing that has had success since the January highs has been tech, and primarily the cap-weighted tech names being the FANG stocks. That's been the place where if you've been fortunate and overweight there, that's where the money's been made. But from a broad market perspective, being the S&P 500, and you drill down the NYSE, which is several thousand issues, or you try to diversify and go globally, this has been a downward time period since the highs, or since the 261 level was hit in January. So I'm going to stay with our theme that we started in the last series of webinars of the good, the bad, the ugly. I think there's some of all three that apply to the markets, and so we want to start out with the good. And the good that's taking place that we continue to share every week in the global dashboards is the advanced decline line. As of today, the advanced decline line is at all-time highs. It's continued. You can see this upward trend channel that it's in. It's been very strong. It's hit the top of the channel a few times and then traded to the bottom, top of the channel, trade to the bottom, and now we're back to the top of the channel. And so there's no negative divergences taking place. The AD line is continuing to send a strong and positive message to the broader markets. And that's why in the global dashboards, despite this choppiness from a buy and hold perspective, we have suggested just to keep the same positions that you've had at the beginning of the year. Not that they've made a bunch, obviously, since the 261 level, but they are up on the year. You can see on the right side, the left side is a weekly AD line. The right side is a little more microscopic view of the AD line. You can see that the daily line is very close to its all-time high, and it's been soft a little bit the last few days of August and into the first part of September. The only thing that I would say is, from a Boy Scout perspective, to be prepared for is in 2007 at the top there was, let me go way back. Let me go back to 1998. The advanced decline line in 1998 started heading south while the S&P 500 continued to go up for 2 more years. So that was probably one of the greatest divergences in the advanced decline line, that in my 40 years that I've seen. And so far since 2000, we've never seen that long of a divergence before a large downturn in the market. So one thing to keep in mind is we don't have to have a negative divergence. You can see the AD line was in a strong upward trend in 04, 5, 6, and 7. As it reached the top of the channel, then it broke support. That's when some trouble got started. So right now, only good messages are coming from the AD line. From a macro point of view, if the AD line would break 3-year rising support at 1, that would be one of your first cautionary messages from the AD line in a few years. So right now, continuing to send a really positive message. This is kind of a global stock dashboard. The top 6 charts are American indices. The upper left is the S&P. You see the Dow right here, the Nasdaq. In the middle row on the left is the Russell, mid caps, and the value line geometric. So you can see that on the top row that all of the trends are up. There's no bear market taking place, no alerts that ought to be, alarm bells going off by any stretch. The only thing that I see is that they're testing the top of rising channels. And it's valid to say, is a rising channel actually resistance? And resistance is typically a falling trend line in a downtrend. So, to me, these are slight forms of resistance, but in the past, you can see in 2000 in the Dow, 2000 in the S&P, a few times here in the Nasdaq. When these indices did hit the top of these channels, they paused at least for a little bit. So that's the only minor thing that I would just want to make sure that you're aware of. Solid trends for each one of these. They're above 50, 100, and 200-day moving averages. The 50-day is above the 200-day moving average from a lot of people have the debate on the golden cross or the death cross. So the golden crosses are taking place, positive moving averages across the board. Now the bottom line is a snapshot, a look at Europe. We have Germany on the left, France in the middle, and London on the right. I zoomed in on each of these primarily for one reason is that they are in long-term uptrends, but since earlier this year, you can see that each of these now, these are weekly charts, have created a small series of lower highs. And so, as we saw in one of the early charts, and what we've tried to highlight the last few weeks in the sectors reports is, so far this year, America's Arnold Schwarzenegger. America's been very strong. The world is a different animal when it comes to Europe, and particularly the emerging markets, and China, Brazil. They're anything but strong. A few of them, I don't really care for the characterizations of corrections and bear markets. Some people use the adage, if it's down 10% from its high, it's in a correction, 20% is a bear market. The bottom line is whatever adjective you want to use, these puppies are off, and they're off a good bit since those January highs. We saw that early on. So the takeaway here, good news on the top 6, moderate caution news in the lower 3 from Europe. Again, we'll come back to the S&P 500 chart where we applied Fibonacci to the 2007 high and 2009 lows. You can see here was the high of the 800-pound gorilla in January. And you can see this past month, and this is a monthly chart, everyone, that it did close above the January highs. So it hit a monthly closing all-time high in August, and it closed a fraction around 2% above the prior highs. So I think one of the most frequent questions I get asked, and I'll be humbly and apologize that I don't have the exact answer, is a lot of people ask the great question, what do you consider a breakout? Well, I really don't consider a couple of percent to be some solid proof that a breakout is taking place. Somewhere along the line, if an asset's 5% above it, I think you could pretty much say, well, that's probably on a breakout mode, for sure 10% above, and beyond that is a breakout. So right now it is above the prior highs. It's less than a couple of percent above it. It's doing its best, not acting ugly by any stretch, to get above the January highs. Has a solid breakout taken place? I'd say no. I didn't put it on this chart, but right in here, everyone, is the 161 level off the same 2007 high, 2009 lows. And the 161 level caused the market to trade sideways. You can kind of see in this range for 20 months. But once it got above it, you can kind of see here, got above this prior high, it came back and then came back down and tested old resistances, new support, and then bang, 50% rally in 12 months. So I did get a good question from one of the premium members was, hey, Chris, what would be the ideal breakout situation? Well, one is that it gets, more than a couple percent above it. And ideally, regardless of the asset, whether it's a fib level or anything, one of the nicest or strongest technical patterns is to see old resistance taken out to the upside, and then the asset actually come back and test the old resistance as new support, and then it pushes higher. So that's what we saw, in 2016 here, and that would really be the most ideal. But sometimes, when these assets break out, they don't look back. So the Dow doesn't have the brag point, excuse me, that the S&P does, in that we applied the Fibonacci levels to the 07 highs and 09 lows in the Dow, and you can see that its fib level comes into play roughly around 26,650. Right now, as of earlier today, it was trading at 25,945. So it's a couple of percent below the January highs. I don't think that's a big deal. To me, it's more important what the S&P is doing because it's 500 stocks. than the Dow 30, but we can see that the 30 stocks themselves are lagging a little, but they continue to be in the trading range and below the January highs. The Nasdaq, it is at right at all-time highs, which is a real positive. We did apply in this chart that we've shared in the sectors, we applied Fibonacci to the 2000 high and 2003 lows. And to me, when it comes to tech, those are probably the most two important emotional highs and lows, because that was the dot-com highs. It declines 90% in value and then starts a long-term bull market that started in essentially late 2002. And so Nasdaq has continued to create a series of higher lows and higher highs for the last 16 years. But when you apply Fibonacci to those 2000 high, 2002 lows, you can see that the 161 extension level comes into play at 183. And so right now the Qs are trading at 184. So the Qs are testing. You can see this long-term rising potential resistance line and the 161 level, which obviously, if it would break out above that, would be very positive for this enormous relative strength play. The one thing that we wouldn't want to see is selling take place. I didn't draw a support line in there because you can see that the monthly momentum right now, even though the Qs are at all-time highs and they're making nominal new highs, the momentum has actually so far created lower highs. So internally, a little bit of weakness is taking place. So staying with the theme of the good, the bad, and the ugly, from an American stock perspective, I've got an X through this guy because there's really not a lot of bad things going on in the States. There's some bad vibes potentially that could take place. So I want you to be prepared for, again, from a Boy Scout perspective, what would be the bad vibes that could really disrupt, the marketplace. And so one of the themes that I've tried to talk about now for a few months, and I want to say this, just because something was a leader to the downside in 07, it doesn't mean it has to be a leader again. And just because I mentioned 2000 and 2007, you'll see that there could be some similarities between those two. You can't put an equal sign next to it and say, because Chris talked about 2000, 2007, that means, let's see, both of those declined 50%. So he's talking about a 50% decline again. Humbly, what I'm trying to do is look for potential reversal pivot points, not trying to say if the pivot point does come true, that it's going to be a 50% decline. I mean, it could be a 15% decline. It could be something greater. We'll see, later on, some of the valuations are just stretched, beyond anything that we've ever seen in any of our lives. Doesn't matter how old you are. You'll see a couple of indicators later. But what I want to just continue to remind is, well, at least once, in my opinion, if something's happened once, it could happen again. So the Dow Jones Home Construction Index actually started turning lower, as you can see on this chart. This is the Home Construction Index on the bottom with the S&P on the top. You'll notice this started diverging in 2005. So almost 2 years ahead of the broad market, housing started heading south. I remember around 2006, I was on a company hired me to do a 60-city tour in 90 days around the United States, giving talks on fundamental and technical analysis. And I bought a USA Today newspaper, and as I opened it up, it said, Thanks. Hey everyone, I'm back. Sorry about that. We went from a drought in Kansas to now we can't get the water to stop, and so we got a storm going on again, and some lightning just knocked out our electricity for a couple of seconds. So I apologize about that, and I hope that you can all hear me, and we'll continue to go on. So I was on the slide here just discussing that the home builders 2 years ahead of time diverged against the S&P, and it was a heck of a symbol of what was to come. There was a bubble going on that became known as the housing crisis. And I shared earlier, just because that happened in, 2007, I don't think that we see so many prime and secondary loans going in. So I'm not trying to make a comparison of 2007, to now when it comes to that. But there was a divergence going on then. So I want to continue to bring up that the Dow Jones Home Construction Index, this is a look back on the type of pattern that it formed as it peaked ahead of the market in 2005. And you can see a very similar looking pattern taking place this year. We do have a 9-month divergence going on, which is a pretty good length of time. Obviously, it's not a 2-year divergence, but the bullish case would love to see this bearish descending triangle broken to the upside. And there's nothing stopping the home building index from breaking out to the upside. And if it does, that's a real positive. If home builders would break down here and continue to show weakness, I'm not telling any of you anything new, that the housing sector is very important to our overall economy. And so if the home builders would turn weak and start selling off strongly, I think it'd be a negative influence, to the broad market. Another canary in a coal mine that was a leader of some tough times to come was the banking index in 2007. You can see that they continue to set higher highs and higher lows. It came up and kissed the underside of this rising potential resistance line. And then over a period of, about 8 months, it formed a descending triangle, and which 2/3 of the time is bearish. And then once it broke support, it headed south. So banks off of the 2009 financial crisis low have made a wonderful rally, and they've come back up to essentially the exact same level where they peaked in 2007. And they're also kissing the underside of this rising channel line where they've made higher highs and higher lows. And over the last 8-9 months has created a potential bearish descending triangle, which looks somewhat similar to 2007. And again, as I shared earlier, I'll beat the table over this. Just because these banks and home builders were a leader then doesn't mean they're going to be a leader now. But these are patterns that are catching my attention, and both of them could blow out of the water in a positive way any repeat by breaking out of these patterns to the upside. If home builders take out the prior highs in 2007, and so does banks, then I've wasted your time. And I'll apologize for it, but I feel that it's my obligation to share some of these potential patterns that could be meaningful with everybody. Speaking of banks, I don't think there's any bank that's more important in the United States than JPMorgan. Earlier, we talked about the emotional highs of 2007 and 9. Well, lo and behold, if you apply Fibonacci to the 2007 high in JPMorgan in 2009, guess where it is? The exact same level, 261, as the S&P and the Dow at this point in time. It hit the 261 level earlier this year, and then it's just chopped sideways. And so essentially it's went nowhere. This is a monthly chart, 1, 2, 3, 4, 5, 6, 7. That's February. You can see a hanging man pattern where it peaked in February, and then it's traded sideways since. So I'm very interested in owning JPMorgan if it breaks out to the upside, but it's going to have to play a game of prove it to me. The 116 level roughly is an 800-pound gorilla, but if it can break above that, it would be a positive asset to own, and it would also send a positive message to the broad market and particularly to the banking index overall. Obviously, the last thing that the bulls would want to, they'd get some bad vibes if selling would start taking place in JPMorgan up against the key 261 level. Here's another chart that the bulls want to see break to end the potential bad vibes. This is the S&P 500 over the last 20 years. And in 2000, the S&P, you can see, peaked in March, made a nominal new high, and this is on a monthly basis. And while that was taking place, monthly momentum was creating a series of lower highs. Turn the page to 2007, you can see that it made a nominal new high again in 2007. What did it have in common with 2000? Monthly momentum had rolled over. So we have the potential repeat situation that this past month, the S&P made a nominal new high here at this green bar in August, and monthly momentum is rolling over. Right now, this is just a quirk. This is nothing, more than that. But it could become, to me, the odds that there is a repeat here is low. If there is a repeat and it breaks steep rising support that I don't have drawn on this chart, the impact, could be big. So this section we're not talking about ugly things. We're talking about what to be aware that would send some bad vibes to the long-term bullish case of the upward trend of stocks. And the bad vibe would be as if selling took place on a nominal high with lower momentum taking place in the S&P. A bad vibe that is being sent that so far is not impacting the stock market itself is junk bonds. Junk bonds diverged for over 2 years at the 2000 peak. They diverged for 7 months in the 2007 peak, and they've diverged for over 11 months this past year, starting in 2017, since last summer. So you can see a series of lower highs while the market at the bottom is creating a series of higher lows. So the junk bonds right now sending a bad vibe, but it's not an ugly message. Sometime this could really matter. This is the second longest divergence in the last 20 years. So I'm going to continue to share this in the global dashboard report, because junk bonds historically, when they start heading south, they're sending a message of weakness to stocks. So as we drill into junk bonds, the prior chart was the PIMCO Junk Bond Fund, PHDAX. And the reason I show it is it's one of the few junk assets that any of us can look back over a couple of decades, because the ETF world is so new. We can't look at that. And I want to remind people that this chart, we strip out the dividends. This fund is paying constant dividends, but the thing that you want to look at, whether it's with JNK, HYG, or this type of a fund, is you want to get the dividends out there so you can just see how the net asset value, in other words, you can just see how the price of the bonds themselves are behaving. You don't want it masked or clouded by dividends being piled in. There's nothing wrong with the dividends, but when we're wanting to look for divergences and weaknesses and breakdowns, you don't want the dividends clouding the picture. So this is a look at JNKX of dividends. You can see that it's been diverging itself for a year, making a series of higher lows and lower lows. In 2018, they're pretty much, though, they're a flat bottom, so this has the look of a descending triangle. This is a weekly chart, been rallying for the last several weeks, and it kissed prior month's highs in this falling resistance at 1. And obviously, we're very early in the week, just 2 days due to the holiday, even though this is Wednesday. We're seeing a little bit of weakness taking place. So some negative vibes coming from junk bonds just from the form of a divergence. Junk bonds can send a wonderful message to stocks by breaking out at 1. If they break above prior highs and the 1-year divergence, that would be a nice message. A concerning message and a stronger bad vibe would be as if the 2018 lows would be taken out. This is a look at the Dow over the last 100 years, and the Dow has spent the majority of the last 70 years inside rising channel 1. Now these are parallel channels from the lows in the 40s and the 50s, the 74 when Nixon was impeached, the 1982 low, all tag this lower line. The high, which is a parallel, this lower line is a parallel with this upper line. If you lay it on 1929, you can see the 2000 high was hit, and then the high in January of this year was hit, and now the Dow is still a fraction, as we shared earlier, about 2% below the January highs. So the takeaway here is the trend is up, so it falls into the good category. It's above long-term averages. There's no ugly news coming from here. The bad vibes would come is if you see some selling take place up here near resistance, because momentum is been seldom this high. You can see it that this was in January. You can see that it was actually above 2007 levels, under the 2000 levels, almost equal to 1987 and almost equal to 1929. So these 5 vertical pink shaded bars are when momentum was extremely lofty and rolling over. And so we'd get a bad vibe, you know, the bull case would, is if we'd see selling pressure take place at a double top right at this long-term channel. Obviously, really good news if it can continue to break above the channel and the January highs. Semiconductor Index, we continue to share that we believe that, I mean, it's been a leader since the 2009 lows, even though tech has done well since the 09 lows. Semiconductors have even been stronger. That's why I like putting the leadership hat on semiconductors. They continue to chop around for the last 7 months back at 2000 highs. So this is the high in 2000, and here's where we are over the last 7 months. On a daily and weekly basis, it's been above it a few times. This past month, we did close, and more than just 1 month, for a couple of different times, we have, or the semiconductors have closed on a monthly basis above the 2000 highs, which is a positive. So for the real positive to take place, if it could close a notch above these highs in March and a couple of months ago, that'd be a real positive. So no bad vibes coming from here, but the bad vibes would come is if you could try to draw an imaginary support line. If you'd see another reversal and a break of that support, that's where you'd see concerning, particularly if like the 93 level is taken out, which is this lower end of the trading range. I want to update, so far it's been meaningless in most indices, but the NYSE index, if you remember back in February, there was the hanging man patterns that took place in February of this year. But looking back to the 2000 high, here was a hanging man pattern which represented a critical high in 2000. Another one took place in 2007. I failed to highlight it here, but that's February. Another one took place in 2018. So far, since that hanging man pattern took place, the NYSE has been unable to climb above it. So still good news that the long-term trend is up above long-term moving averages here. We'd get bad vibes if selling pressure would come in and break out below the February-March lows. So from an ugly perspective, really the ugliness is contained outside the greater 50 states. And so this is a look at strong US, weak world. So this is since the first of this year, and you can see that the Nasdaq from January 1st is the strongest, up 16, Russell up 11, S&P up 6. But this is the zero line here, everyone. So then once we start getting outside of the 50 states, outside the United States, then weakness starts coming forward. You see that EAFE is down 750, emerging markets down 13, and this is the Shanghai Composite China down almost 19%. So I wish I had the answer. We don't see this. I don't care how long you've been in the business. This hasn't taken place very often that you see this much of a fish mouth spread between, say, the Nasdaq being up 16 on the year and the Shanghai down 18. The S&P up 6 on the year and EAFE down 7. You know, that's a 13% spread. The spread between the Nasdaq and the Shanghai is 34% spread. That's rare territory, everyone. You know, so as I've tried to postulate a few times, the question is can the world, or can the United States strength pull these global assets out of their corrections and bear markets, or are the correction and bear markets from around the world going to reach across back over here to the States and say, hey folks, you got to join us, and we're bringing you down. So there are, I think there's a lot of things to watch for, in this, and that's why I say we want to watch for bad vibes. We want to know what the good characteristics are to see if the United States can pull it up, or is the world going to pull the United States down. So here's an ugly chart that's taking place. This is the Hang Seng Index out of Hong Kong. You can see the 2007 high where it took place. You can see that the rally off of the 2015 low attempted. There was what you would call a throw over. This is why I say, everyone, what constitutes a breakout? The Hang Seng did break above 2007 highs earlier this year. It's really easy to say, Yahoo, let's hop on board that bandwagon. We got a breakout in hand. And if you write the word breakout, you need to cross out break and write fake. It was a fake out. And so what did it do? It was hitting the top of two rising channels at one. You see this green rising channel taking place, and you see this blue one. And it kissed the underside of both of those as it was pulling a very quick reversal pattern in January, and then nothing but weakness has taken place since. And now the Hang Seng Index has broken 3-year rising support. And it's also broken below the 2015 highs. So the next key support level comes into play around 20%. If you think of these channels, about 20% below current levels. So if the Hang Seng would continue weak and that selling pressure continued to just pound this market, I think it really works against the odds that the S&P has success getting above the Fibonacci 261 extension levels. So let's look at Germany. Germany, the trend is up. Germany, you can see this is a 20-year chart, so we're not looking at a short-term time frame. I want you to focus right up here. You can see that it hit a resistance, rising channel resistance line. Is that a double top? More importantly, is that a head and shoulders top that's formed over the last 1.5 to 2 years? Obviously, it's all a sideways action. Nothing is proven. Long-term trend is still up. 2-year trend is just choppy sideways. It's testing rising support. What would get ugly is if dual support here at 3 would break. So continue. I put the DAX in our reports every week, along with the France markets, because I truly believe what these key European markets will do are going to influence us. My mentor being Sir John Templeton before he passed away, one thing that he beat the table on, he said he thought the markets were extremely risky in today's world. And most people, and myself included, okay, he's talking about valuations. And John, he wasn't even scratching the surface on valuations. It was about correlations. Because John started, the Templeton Growth Fund in the 1960s, and it was very easy to diversify, put assets in different places, and get really different non-correlated performances. Somebody could make the case, well, there's a lot of non-correlation going on this year. Chris, if the Nasdaq's up 16 and the Shanghai's down 18, that's a 34% spread. There's a lack of correlation there, and that would be true. But for the most part, over the last several years, the world's a highly correlated place. One place sneezes, the other catches a cold. One breaks out of the barn, and the bull starts running, and so do others follow. So until that changes on a longer term perspective, correlations are still, to me, very high and something to respect. So this is a key support test that's taking place on the DAX. Turn the page to France, same thing, trends up, been chopping over almost the last 2 years. You don't see nearly maybe as well defined as a potential head and shoulders top. It's possible, but the bottom line is if it would break below this spring's lows and break this 2-year rising support line at 1, don't be surprised to see more selling pressure. So potential ugly news, another one would come from Europe if we saw continued weakness out of France. So if we look at EFA on the left, emerging markets on the right, both soft this year. We discussed that earlier. They're both below 2007 highs. Even though the S&P is well above 2000 highs, the Dow's above that, the Nasdaq is above it. These important global perspectives or barometers have not gotten above 2007 highs. All that they've actually done is created lower highs from the 2007 highs. They both peaked at the top of rising channels. Since last year, both have created a series of lower highs, and they're breaking down below 3-year rising channel support at each number one. So from a global trend perspective, these continue to send ugly messages. Another potential ugly message that we have to watch is the Shanghai Index. In 2015, it peaked below the 2007 high. But the key here is it spent a good deal, not every month of every year by any stretch, but it spent a good deal of its time above this rising support line since 2005. And so it's attempting in its weakness since late last fall to break that support. This blue horizontal line is the 2015 lows. So if China, if the Hang Seng continues weak, FXI, the China ETF continues weak, if the Shanghai Index continues weak here, I think it would send an ugly message to the States. So we've got to really watch our P's and Q's and risk management because of some of these global messages that are coming. So I want to move away from some of the chart patterns right now, and every once in a while, to me, conditions warrant that we want to talk about some macro valuations, some statistics, and some emotions. And so we're going to look into some sentiment, some valuations. Each week I put this into the sectors report, and this is the CNN Fear and Greed Index. You can see that it's not at any radical extreme, but it is, a year ago, as an example, it was at 49, so we're definitely higher than a year ago. 1 month ago, it was at 71. It's currently at 68. A week or two ago, it hit into the category that because it was above the 70s, it entered into their category of extreme greed. So that's just a really fine line in the sand. It's not way off the scale, but it's also not a time that, from a buying perspective, we'd love to see it, over here. Not overly concerned about it, but it is somewhat lofty. So just hang with this chart. It appears to be a little busy, but it's really not. This is the American Association of the Individual Investors from Investors Intelligence. So the green line is the percentage of investors that are bullish. That's on the right scale. The blue is the number of investors that are bearish. And then the red line in the bottom is the bull-bear spread. So I think one of the fun things to focus on is this spread. Is when the spread is low, you have a lot more bears than bulls. And, when prior to Trump getting elected, not about him being elected, is about the markets, but the markets took off strongly in 2016. Once they broke above that Fibonacci 261 level after they traded sideways for 20 months, the S&P rallied 50% in 12 months. Part of the fuel for that type of a rally was how many people were bearish. And you can see this in this spread right here. If you go above, you can see that a lot of people were bearish in the blue, and at these points of time, very few people were bullish. So right now, the spread is not in extremes, somewhat lofty, not crazy high, but you can see earlier this year when the market started its choppiness, when you think back on the early slides, what assets have performed the best? If you put 100,000 in the S&P as it was hitting the 261 level, if you made 1%, you'd have 101,000. So the S&P would be worth an $80 gain, and then the NYSE would be what, folks, worth 96,000. EFA would be down like to 88,000. China, emerging markets, would only be the 100 grand would only be worth 80,000. So there's a lot of global softness that's taken place, and ironically, a treasury bill would be ahead of the pack if you sold at the 261 level, when we tried to advocate capital preservation as the key, folks, at that time. So takeaway here is you can see that it's high, but not really at too bad of extremes. But this is typically not where really solid bull markets take place. This is something I find fun to look at. This is the amount of money that's in leveraged bull and bear funds at Ridex. So on the prior slide, if you remember, the bull-bear ratio was very low in 2016, in early 2016. That's when the market turned up. Well, look at this ratio. This was the bull-bear. So in other words, there really wasn't very much money in bull funds compared with bear funds, or there was really a lot more money in bear funds. I can't say that there was more money in bear funds. That's not true, but not many people felt confidence to buy the levered bull fund, and more people felt confident to buy the bear leveraged fund. So turn the clock forward to when the S&P was hitting the 261 level. Look at that, folks. There was the bull-bear ratio of bull leverage to bear leveraged was at its highest point in several years. So this index is not as high as January, but it still remains lofty and obviously much higher than the lows in 2016. So we get, this is not ugly, but you get bad vibes if you start seeing this ratio, head lower. But it is obviously at lofty levels. So in honor of my hero, Sir John Templeton, the next 3 slides, we're going to kind of discuss some things that I'm turning the clock back to the late 90s. That's when Sir John said, hey, Chris, for a variety of reasons, I think buy and hold is going to struggle, and that the market at best will be flat 15 to 18 years from now. Keep in mind, if the year was 1998, I'd been in the business at that time then 18 years. The Dow went from 1,000 to thousands higher, 20-year run. I didn't want to believe, and I found it hard to believe what Sir John was saying. But this is kind of an interesting piece from the Loophole Group that, I don't believe that there's any one chart pattern that's the holy grail, and I don't believe that there's any one market fundamental tool that's the holy grail. But there's something I like about the next 3 charts that we're going to look at, because, folks, they're composites. So this chart, if you look at the top, is made up of a combination. So it's throwing them in the blender and putting them all together and see what comes out. So it's the S&P trailing PE ratio, the inverse of the 10-year Treasury bond yield, Michigan Consumer Sentiment Index, the U.S. corporate profit margin as a percent of the GDP, and the inverse of the U.S. labor unemployment. That's a whole mouthful, isn't it, everyone? So I'm glad that they put this together. But I think, it does show some true extremes in this chart. If any of you are good historians, or if you would look back on a chart, does anybody know where the Dow was in roughly 1965? It was about at 1,000, everyone. So, at this time, roughly 15 years into when they were doing these statistics, the Dow was at 1,000. Now you see a huge extreme in 1982. Anybody would know where the Dow was in 1982? 1,000. So it had went a decade and a half just chopping back and forth, going nowhere. But this indicator, this collection, this whole cauldron of, you think of a witch's brew, was very high in 65 and very low in 82, and man, did it nail it. Those were some of the largest extremes in a long, long time. And then you can see there was another fairly good low in 1990 before we had a 10-year run-up. Now here was 2000. It was fairly high. The only time that was higher was 1965. We know the dot-com peak. Here's 2006 when it peaked out, almost a year ahead of the market. But then you also see another extreme of 2009. So up here in the top, has any long-lasting bull market to where you could put $100,000 in, and 5 years later it was worth $130,000? Never happened, folks. Now, if you put 100,000 in here, it wasn't very long you had a lot of money. You put 100,000 in 1990, it wasn't very long you had a lot of money. And you put 100,000 in 2009, it wasn't very long you had a lot of money. So this is, to me, a really a fun tool to look at. It's a collection of things. The takeaway right now, this collection of this market utilization mixture is now the highest in 50 years. So this does not mean the market has to top here. If you put 100 per 100,000, could it become 110 or 120,000 in the future? in the short term? And the answer is absolutely sure could. But the odds are not really great. I know that most of the audience is not from a buy and hold perspective, but the odds are not very great. You put 100,000 in, that it's worth a couple 100,000 a couple years from now. Odds are good if you're down here that that's happened. So far, that hasn't happened in the last 50 years when it's up here. So here's another hodgepodge, and I'm not going to go through and read all of these, but this came from Crest Cap, their model. These are all different things, and you can look back on this webinar. I'm not going to read through all of them, but the bottom line, it compared historical percentiles at previous peaks, which was the peak in 2000, 2007, and today. So then you put it all together, you put it in a graph, and here's what you have. So this, excuse me, this goes back to 1987. You can see their collection of indicators where it stood in 2000. More importantly, here's where it stood in 1990, before the 10-year run-up. This was 2000, another great buying time in 03, another great buying time in 09. Here's where it stood in 2007, and here's where we are currently. So another reason that I like this is that I'll continue to beat the drum. Every good strategy has its weak points, and no one single indicator to me is the holy grail. But it is interesting. It's like when Sir John shared with me, Chris, I think the market can struggle for a while, and he went through a litany of things. I'm just trying to do the same for you as the favor that he did for me back in the late 90s. Some little small bank investment firm called Goldman Sachs put this collection of indicators together. The collection, you know, is ISM, the slope of the yield curve, core inflation, unemployment, and the Shiller PE ratio. The bottom line is there's that 1960s again, where the Dow didn't go anywhere for 15 years. There was the early 80s where the Dow was at 1,000, and despite the 87 crash, it ends up thousands and thousands higher by the end of the 90s. But there's 2000, and there's 07. So currently, the Goldman Sachs model is higher than 2000 and 2007, and the only other time in history was the mid to latter 60s was this collection of indicators any higher. So again, this is not about being bearish. This is not about that the market has to peak here. All this is about, folks, is being a Boy Scout. Be prepared, be knowledgeable, don't stick your head in the sand, and know that the market trend is up. Bad things are not going on, but this is not the price point typically where solid big gains take place over a 3 to 5 year window. Another one that Sir John brought up to me was margin debt. In other words, how cocky are people? Are they willing to actually go out and put money, home equity loans, shorter term loans at the bank, or credit cards? Are they willing to do margin debts also in their brokerage accounts? So two lines here. The blue line is the S&P, and the red line is the margin debt, but turned upside down. And I like this chart. I apologize you don't like inverted charts, but this is the way it is that I like this because it's when the spread takes place. How far apart are these puppies, and when does the margin debt actually contract? So you can see in 2000, it's not when margin debt in and of itself, we've covered this several times, being high is not a bad animal in itself. It's when people that have margin debt that start saying, I got to get out of debt. I got to pull that debt back. I got to sell it off. I got to sell shares and reduce my debt. That's when typically then the market can struggle. So you can see that there was a spread in 2000, and once margin debt started turning up, that's when the market struggled. You can see the spread in 2007. Once when margin debt turned up, that's when the market struggled again. So now you can see that the fish mouth spread, man, this is a big largemouth bass spread going on, folks. This is the biggest spread, obviously, that's taken place in a couple of decades. So the thing to watch for is not that the spread is so great, is if the spread starts narrowing. So this statistic is not something that you get daily, weekly. It's only once a month. And so this is August, which would have been taking place in early August. So a new one will be coming out, really soon. But again, the point being, this spread's really wide, and if it starts to narrow, it would send a cautionary signal at the least to stocks. Here's the same idea, looking at when investors have positive credit balances. That's usually when markets are at bottoms, and when they have negative credit balances, in other words, they have a lot of margin debt on the table. So you can see in the tech.com bubble. You can see where the S&P was, and you can see that at that point in time were the largest negative credit balances in history. We know what happened. And then when they had positive credit balances, in other words, they'd really reduced outstanding indebtedness, you can see a great bottom was taking place. Here was the high in 07. You can see the negative balances. Then look at the 09 lows, the largest credit balances in the last, 40, 50 years. And then now we see a ton of negative credit balance taking place. In other words, there's a lot of margin debt, out there right now. So if this would start to shrink, that would send a cautionary message to stocks. So just kind of encapsulate all of those mouthfuls I just shared with you. Again, the bottom line is none of this has to stop markets from going up. It doesn't make me bearish, but it does make me think of the game musical chairs. That when you play that game, whether you're young or old, you best have a strategy and know when that music stops what kind of game plan that you have. So some of these bad or potential charts that we shared, I want to empower you to watch for these type of vibes that take place. I want you just to know where the exit sign is and have your risk management for yourself. The only person that knows you the best is the one that you look at in the mirror in the morning. And so you're the person that can understand risk exposure and stops. It's not for me to tell you your own personal risk exposure, but it is an obligation to me that I want to share these big macro pieces, things that I learned, that I went through in the 90s that shared with Sir John. And, there's no way I can ever, I wish I could, bring Sir John on the line. Obviously he's deceased and he passed away a few years ago. I often wish, what is he saying? What would he be saying now? But all I can lean back on is what did he say then? And are there any parallels today to those times that he raised the flag, not of bearishness, but just of caution towards your assets? So just looking at commodities, real quick, this is crude oil. We took the monthly closing highs in 08 and the closing highs of 2016, around the $33 level. So this was a high of 140, low of 33. The $74 level is the 38% retracement of that huge decline. So once crude oil hit that a couple of months ago, again, this is a monthly chart, everyone, it hasn't fallen apart, but it's also struggled to push much higher. While this is taking place monthly, momentum is rolling over. Not terribly, but it is so far below the highs that we saw a few months back. I do believe this is one of the most important commodities, or it is the most important commodity in the world. As you know, some countries almost use this as their own currency to trade. So to me, it's really important, the strength or lack thereof, the signal that can come from the crude oil, marketplace. From extremes of smart money, what they're doing. Smart money was betting that crude was going to fall to the largest degree ever in 2014. The end result is crude oil fell 70%. And then smart money made one of its biggest bullish bets in 2016 when it was around the $30 level that it was going to rally. And the smart money was right as it rallied 100%. And now you see that smart money is betting to the largest degree in history that crude oil is going to decline. So we'll see if smart money is correct again. This is our continued update that I put every week in the sectors report. This is the Thomson Reuters Equal Weight Commodity Index on a monthly basis over the last 30 years. The index has spent the majority of its time since the 01 lows inside rising channel 1. If you go back to here, 1990, it's still spent almost 20 years inside rising channel 1. It hit the top of it in 2011 and then started creating a series of lower highs and lower lows inside the red shaded falling channel 2. So it hit dual support in 2016. We had then a counter trend rally. We've chopped sideways, tried to get above those prior highs, hit the top of falling channel 2 a few months ago. And this past month, for the first time since 2016, that commodities have broke below this long-term 16, 17-year rising channel at 3. So historically, this is not the best of news for commodities. You would forget all of these different channels that I shared. Right now, to me, the key is the 2017 lows. So if it breaks, below that, then the downward trend continues. And, it's not a surprise to see, commodities, with this pattern. To me, everyone, we shared this with our members in 2014. But to me, this looked to be the largest head and shoulders topping pattern I'd ever seen. And I mean, this is in hindsight, so all of us it's not cheating, but you just got the advantage of looking back in history. I couldn't find any other index that made a potential topping pattern, a head and shoulders topping pattern over the left and right shoulder over a 9-year spread. And so we saw this, big decline. This could be the neckline. This has obviously been a little bit of a blurb. If commodities would ever break below these two lows, which would be the neckline, it's like sayonara for commodities. So it's really important that commodities can hold above those two lows. So it's just going to wrap it up. The last couple of charts, there's nothing that's, if you have been fortunate and you've overweighted, I mean, big time towards the FANGs, towards the cap weighted in the tech sector. 2018, since January hadn't been a choppy event, it's been a positive event. As all of you know, that the leading place that's holding the market up is a few tech stocks in America. So I just kind of wanted to share, one of the highest flyers. I mean, if you look back not too long ago, Netflix was at a couple of hundred, and then all of a sudden, next thing you know, it's at 400. So what gets my attention here, folks, is this rapid rise. As you know, many of you know that have been following me for years and years, I coined the idea of the Eiffel Tower pattern, that if you see an indice or a stock that is has a level of ascent like a rocket ship or like the left side of the Eiffel Tower, that oftentimes these rapid rallies, when they break support, that the right side of the Eiffel Tower can look the polar opposite of the left side. And so this is a Netflix on a monthly basis, and you can see that we see really two really large bearish reversal patterns or bearish wicks. Those are pretty big. There's hardly any stocks, as you know, that have done better than Netflix. It's in a small collection of companies with Amazon and not too many others that have been so darn hot, just white hot. So you do see that Netflix has broke below this really steep year-long rising channel after these two bearish reversal patterns. So the bulls in Netflix, obviously, if you're in it, I'd be really careful and set some stops, right in here. But the message to these high flyers is that Netflix bulls don't want to see further selling after this potential Eiffel Tower pattern is formed. One of my advices early this year, when I sent out the message that capital preservation is the key, is that I'm not going to take a lot of positions, and the positions I'm going to take are going to be very small. And but that's been the norm since January. But this was the non-norm or the outlier that essentially 2 months ago on July the 2nd, I suggested to load up on Apple. I took personally a large position in Apple. It was when I shared take a full position, or whatever a full position means to any of you, it's your own criteria, not mine. But I really liked what I was seeing as Apple was in an uptrend. This looked like a bull flag, and it was breaking from that. And so Apple obviously has not rallied as much as Netflix, and it hasn't rallied as much as Amazon, but it is up about 20% in 60 days. And so, with this in mind, if I set a tight stop, on Apple, I did take some profits on it, but if Apple would happen to do like Netflix and happen to roll over and break support, our stop is going to be triggered, on this monster, position. And so whether you got a monster position, a small position, or whatever in Apple, I'd still use a similar stop, a line in the sand, that if it breaks that, I'd take some of these profits, because that's a pretty good sized gain for still a large, one of the largest companies, obviously, in the world. So I continue to send this out each week at the end of the sector's report. These are the top stocks that have performed well over the last 10 years in the month of September. Ulta, the cosmetics company, ULTA, has an average or a median gain of 12.5%. I shared this a couple of weeks ago, before the end of the month, and for whatever reason, ULTA just started screaming higher, even before the end of the month. So it's pretty much met its September goals just in the last 7 or 8 trading days. So incredible. But we see more upside breakouts. I'm watching all these patterns of these leaders. If we do get some breakouts in these stocks, but you'll notice there's a big discrepancy from first to second place. That the second L Brands is not doing well at all, but its average gain in the month of September is 6%. So most of these numbers are not near as strong as this one outlier leader of ULTA. So I want to thank you for your membership. Thank you for your patience. Thank you for the fun I think that we've had. Just the longer anything can go sideways, folks, the bigger the move that it's going to be. And so we saw that at the 161 level. It traded sideways for 20 months. And then for those that were patient and hung with it, the market went up 50% in 12 months. So it'd be really nice to see this market work off some of these excesses, get to the bottom of the trading range, because then I think we have even more opportunities. So I wish all of you a happy fall for all of those that are football fans, and exciting time of year. So again, thank you for your membership and best wishes, everybody. Have a good day.